Okay, let's try and make sense of this. What an absolute mess in the markets. People were calling it Black Friday. But believe me, there were no bargains to be had here. This was less a correction, more like evaporation. And just to put a number on it, because the scale is frankly staggering, over $20 billion gone, wiped out across exchanges, both centralized and decentralized. That took 1.6 million leveraged positions down with it. I mean, that's not a dip. That's a catastrophic deleveraging event.
It really was a defining moment, maybe the defining moment for this cycle so far. Yeah. And what we need to do in this deep dive is really unpack how this perfect storm came together. We'll look at the ingredients, the geopolitical spark, the incredible amount of leverage built up, the structural weaknesses.
And the infrastructure failures too, right? That seemed key.
Absolutely. And then we'll see what the aftermath looks like and, how the experts are reading the tea leaves now.
So high level, the sources are pointing to three big things hitting all at once. U.S.-China tensions flaring up, that massive leverage you mentioned.
A ticking time bomb, basically.
Right? Yeah, exactly. And then the platforms themselves buckling under the pressure. All right, let's start with the spark. Geopolitics. It seems President Trump's posts threatening 100% tariffs on all Chinese imports really set things off.
That's right. And the sources are specific. It wasn't just general trade war noise. This was laser focused on rare earth minerals.
Okay, but help me connect the dots. Why would tariffs on rare earths cause such panic in the crypto market specifically? Seems a bit removed.
Well, it's about the bigger picture.
Yeah.
Rare earths are fundamental to everything in modern tech and manufacturing globally. So if you threaten massive tariffs there, you're essentially threatening to throw a huge wrench into global supply chains, global manufacturing.
Right. Okay, so it's a massive global risk-off signal.
Exactly. Investors see that instability, they get nervous about global growth, and they pull back from anything considered risky.
And crypto is way out there on the risk curve.
Right at the far end. So it reacts often violently to these big macro shocks. But, and this is crucial, the market was incredibly vulnerable before the news hit. The system was just primed for this kind of shock. Before the crash, Bitcoin's open interest. The key meter of leverage was sitting at an unbelievable 90+ billion.
90 billion? Seriously?
Yeah, it's hard to even picture. It's like a skyscraper built on, toothpicks. Just fundamentally unstable.
Okay, so the tariff news hits this incredibly fragile structure, and then you get the cascade. Explain how that works again. It sounds brutal.
It is brutal, and it's almost automatic. Prices start to fall because of the news. And those highly leveraged positions, the ones built on those toothpicks, they immediately hit their liquidation points. The exchanges automatically foresell them.
Right, to cover the borrowed funds.
Exactly. But these aren't small sells. These are massive market-moving sell orders hitting all at once, which, of course,
pushes the price down even further.
Precisely. Which then triggers the next wave of liquidations. It's a vicious downward spiral. It feeds on itself.
So that $20 billion wipeout wasn't just people losing money on paper. It was the system forcibly closing positions.
That's a huge part of it. It's the volume of forced selling needed to clear out all that excessive weak leverage and sort of reset the market.
And then just to pour gasoline on the fire, the actual trading infrastructure started failing.
Yeah, that made a bad situation much, much worse. Major players, Binance, Coinbase, various DXs, they all reported problems.
Like what kind of problems?
Glitches, order books freezing up so you couldn't place or cancel trades, and really critically, Oracle issues.
Oracles. Those are the price feeds for DeFi, right?
Exactly. And if those price feeds become unreliable or delayed when prices are moving that fast, well, smart contracts can't execute properly.
So DeFi basically breaks down.
Trading becomes chaotic, unpredictable. Even if you wanted to manage your risk or get out, you might not have been able to. The system itself amplified the panic.
Okay, so while everyone's dealing with frozen screens and bad price feeds, this other angle starts to emerge. The suspicion that maybe this wasn't all just bad luck and bad timing.
Yeah. The idea that this might have been, let's say, anticipated by some.
Anticipated is putting it mildly. We're seeing reports, pretty detailed ones, about a single trader netting around $190 million profit.
And the timing is, let's just say it raises eyebrows. Big time.
Tell me about it. They were shorting Bitcoin and Ethereum just before Trump's tariff announcements?
The sequence laid out in the sources is quite specific. First, about $80 million deposited to short Bitcoin.
Okay.
Then, a few hours later, another $30 million added to short Ether.
Right.
And they kept adding to these shorts aggressively right up until 1 minute before Trump's follow post confirming the 100% tariff threat.
1 minute before? That's incredibly precise.
It is. And then About 30 minutes after that post, all the shorts were closed. Profit taken.
Wow. The size, the timing. It's hard not to be suspicious.
Yeah, it really is.
Yeah.
Now, legally, we know Bitcoin and Ether aren't securities in the traditional sense, so the term insider trading doesn't technically apply here.
Right. That's an important distinction.
But the observation made in the research cuts deeper, I think. It says, and this is a quote, "The real alpha today isn't analysis, it's access."
Oof. That's a pretty damning statement for the average investor, isn't it?
It suggests that having privileged information, especially about geopolitical events or major market moves, is now more valuable than any chart pattern or fundamental research you could do. Access trumps analysis.
And it feels like we're seeing this elsewhere, too.
Yeah, the sources draw a parallel to another recent event. Apparently, some large traders, whales, loaded up on AMD call options right before the news broke that OpenAI had taken a 10% stake in AMD.
And what happened to those options?
They jumped 300% in 2 days.
So same pattern. Access to non-public market-moving info leads to huge gains, whether it's tech stocks or crypto.
It seems to be the emerging narrative, unfortunately. Acting on information before it becomes public knowledge is the clearest path to outsized returns right now.
Okay, so the $20 billion storm hits, questions about access are swirling. What happened immediately after? What did the market look like?
Well, one key indicator mentioned is altcoin open interest, the leverage in smaller coins. Apparently, it got cut almost in half.
Halved. Wow.
Yeah, down to around 29%. That's a massive deleveraging. And, historically speaking, that kind of deep clean out where all the weak leverage gets flushed, it can sometimes signal that a market bottom is forming, or at least getting close.
Interesting. Did we see any concrete signs of stabilization or maybe confidence returning?
We did, on both sides, actually confirming the severity, but also the response. First, the cost. Binance ended up paying out $283 million in compensation.
Compensation for what?
For users affected by the depegging of certain assets like USD, BNSO, and WBEF during the crash, their values went off kilter because of the volatility and infrastructure issues. That payout shows just how disruptive the event was structurally.
Okay, so that's the damage assessment. What about confidence?
On that front, we saw a pretty strong signal from the institutional side. Mara Holdings, a big Bitcoin mining company.
Right.
They jumped in and bought 400 Bitcoin for about $46 million right after the crash.
Buying the dip, basically. Or buying the crater, maybe.
Exactly. Buying when there's blood in the streets, as they say. They didn't wait around. They saw value and acted. That's a real vote of confidence in Bitcoin's long-term prospects from a major player.
That is a strong signal. And meanwhile, the trigger for all this chaos is fading.
It seems so. The reports indicate Trump is already softening his tone on China again, walking back some of the tariff rhetoric, which provides a bit of relief to global markets, including crypto.
Okay, so the immediate dust is settling. Now, inevitably, the experts start weighing in on what this all means for the future of this cycle. And it sounds like there are some pretty different takes.
Oh, yeah, definitely conflicting views. It's really important for you, the listener, to hear both sides, the bullish case and the more cautious, risk-focused perspective.
Let's start with the bulls, Benjamin Cowen's view.
So Cowen is basically holding the line. He still believes Ethereum is heading towards $5,300 this cycle. In his view, this whole 30% drop, as dramatic as it felt, was actually expected. Just part of a normal, healthy correction within a larger bull market.
He expected a $20 billion liquidation cascade.
Maybe not the mechanism, but the depth of the correction. He points to a specific technical level he had apparently predicted an Ethereum wick down to around $3,500 before the next leg up.
And that happened.
Pretty much, exactly. During the crash, ETH hit that $3,500 level. For Cowen, that's confirmation. It validates his read of the market structure and its underlying strength.
So for him, the plan is still on track unless something specific breaks.
Right. His main condition for rethinking things is if Bitcoin were to close below its 50-week moving average. Until then, he sees this as noise within an ongoing uptrend.
Okay, but here's the thing that bothers me. This wasn't just a technical correction triggered by market mechanics. It was sparked by a geopolitical event that seems to have been, well, front run. Doesn't that change the game? Can we still rely purely on charts?
That's the million-dollar question right now, isn't it? That tension is exactly what defines this market environment, which leads us nicely into the other perspective, the risk management thesis, mainly coming from Ivan on tech.
What's his take? Panic.
No, actually the opposite. He's urging calm. He's warning people not to do revenge trading, jumping back in aggressively with leverage to try and win back losses immediately.
Sensible advice.
He also argues that the crash wasn't totally out of the blue from a technical perspective either. He points to what he calls a flaccid breakout just before the crash.
Flaccid breakout, what does that mean?
It means Bitcoin pushed to a slight new high, but there was no real power or follow-through behind the move. It looked weak, lacking conviction, which is a warning sign even before the tariff news broke.
So he saw technical weakness, Trump posts hit, cascade happens, his view on the liquidations.
He actually sees them as painful, yes, but ultimately a healthy reset. It cleared out the weak hands, the over-leveraged players, essentially cleaning the slate.
Preparing the ground for the next potential move up if it comes.
Precisely. Interestingly, he also noted an anomaly during the chaos.
Oh.
While almost everything else was plummeting, Zcash, the privacy coin, actually held its ground and even continued to move up slightly.
Any thoughts on why?
He suggests it might point to a growing interest in privacy coins, maybe as a sort of counter-trend bet amidst all the instability, something to watch, perhaps.
So his bottom line for traders now?
It's simple. Patience. Wait for confirmation. Don't trade on emotion. Wait for the daily trend to clearly flip bullish again before considering re-entry.
Okay, so we have Cowan saying the technicals predicted this dip and the structure is intact, and Ivan on tech saying the breakout was weak, the cleanup was needed, but wait for confirmation. Both seem to agree the cycle might not be dead yet, though.
That seems to be the common thread, yes. Disagreement on the how and why of the crash, but a shared sense that this might be a reset, not an ending.
All right, let's try to pull this all together. We went through how this perfect storm formed extreme leverage, meeting a sudden geopolitical shock.
Amplified by failing infrastructure.
Right, resulting in that $20 billion cascade, the fastest ever. And then we layered on top this deeply unsettling element of potential foreknowledge or access driving some of the biggest moves, which really sets up the final thought, the big question for you listening.
Yeah, and it's this. If the market structure is this leveraged, making it prone to sudden, violent moves, and if the biggest triggers for those moves are increasingly unpredictable geopolitical events, and crucially, if it appears those events can be anticipated and front-run by sophisticated players with privileged access, then what does that mean for you? What tools, what strategies can the average informed investor actually rely on anymore to navigate this kind of volatility? Is technical analysis enough when access seems to be the real edge?
That tension between analysis and access feels like the core challenge now. Definitely something to chew on. Thank you for joining us for this deep dive. As always, keep digging, keep learning, and stay safe out there.